KFC in China. That's because in China, KFC isn't just a fast food stop. It's a cultural phenomenon. It's where East meets West, convenience meets customization, and massive population meets growing middle class. Today, I will be presenting the company Yum China, which has taken some of the most iconic American brands and reimagined them for the world's most dynamic consumer market. So let's dig in. I'm rating Yum China a strong buy with an 80% upside. Its current share price is $44, and my target share price is $81. Here's a few stats to know. Yum China is a large cap company. They have a price to earnings ratio of 18.5 times, and comparing that to their biggest competitor, McDonald's, which sits at a price to earnings of 28 times, they're significantly undervalued. And they have a dividend yield of 2.17%, making it attractive to value investors. So, what does Yum China own? Well, they own 6 strong restaurant brands across China. 3 of them are Western-style chains, KFC, Pizza Hut, and Taco Bell. They also own 2 local concepts, including the hot pot chain Little Sheep and the simmer pot chain Wong Chi Wong, and they also own the luxury Italian coffee cafe Lavazza. Now, how does Yum China make its money? Well, they do it through 3 main ways. The first is core brand performance, namely KFC and Pizza Hut, which make up 70% and 23% of their total store count respectively. Growth in these 2 brands will continue to fuel sales. Second, you have rapid growth. In 2024, Yum China opened up a record number of stores all time. As they continue to accelerate their store growth, we're going to see revenue accelerate right along with it. And finally, you have digital and delivery channels. Yum China makes 90% of their sales digitally, and delivery sales grew 16% in 2024, marking a decade of double-digit growth. As they continue to build out their digital and delivery outlets, we're going to see revenue streams from both these different areas. Now, what makes Yum China so appealing in today's market? Well, there's 4 reasons. The first is shifting consumer preferences. China's undergoing a phase of rapid urbanization, from a 51% urbanization rate in 2010 to a 67% rate in 2024. With urbanization comes busier lifestyles and a prioritization on convenient fast food. Yum China is the market leader in the Chinese fast food industry, positioned to capitalize on these trends. Second, you have low-cost offerings. As China's in a state of economic uncertainty, Yum China is adapting through their affordable pricing models like their Pizza Hut Wow stores and their KFC meal bundles, which allows them to continue increasing consumer transactions as well as grow entirely. Finally, you have digitization. Yum China is implementing artificial intelligence across the board, from behind the scenes in the supply chain to in the kiosks up front. And that is allowing them to become more operationally efficient and grow a profit, as we'll get onto in my financials. Finally, you have coffee expansion. China's coffee sector has grown at a rate of 21% annually since 2010, and Yum China is capitalizing on this, capturing both sides of the market through their affordable K-Coffee and their upscale Lavazza cafes. So, let's shift focus to an industry analysis. The Chinese fast food sector grew 7% in 2024, faster than the broader restaurant sector overall. Yum China is at the forefront of this transition and able to make more revenue from it. Now, one of the main strategies that Yum China uses that I want to target is targeting lower tier cities. These are cities with less development, but super fast growth and little competition. In fact, 50% of Yum China's openings in 2024 were in these lower tier cities, cities with lower labor costs, lower rent costs, and all of that allows them to become more profitable and generate cash flows, which is important. Now, let's shift focus to a moat analysis where Yum China has a wide moat for a few reasons. The first is brand strength. KFC and Pizza Hut are entrenched into the Chinese culture over decades of experience there, and they're household names in the region. That gives them the advantage simply by their name brand over any other competitor in the region. And it's shown. They have double the stores of their closest competitor. Which leads me to my next point of scale and distribution. Yum China is by far the biggest fast food chain in China, which allows them to take advantage of economies of scale, spreading fixed costs across all of their stores, and thus achieving a level of efficiency that no other brand can. And finally, you have digital loyalty. Yum China has 525 million digital loyalty members, and in fact, 65% of their sales are recurring sales from digital loyalty members, which tells us that once they get customers ingrained into their culture, they get them coming back. And that is creates high switching costs that no other brand can replicate. So, let's take a look at Porter's 5 forces. Firstly, the threat of new entrants is low. That's because as the average Chinese restaurant closes down within 500 days, Yum China is able to scale quickly and continue scooping up that market share. Second, the bargaining power of suppliers is also low. That's because Yum China works with 800 independent suppliers, mitigating the power that any one of these suppliers has over the company. Thirdly, the power of buyers can be considered significant. That's because if money gets tight, they don't have to go out and spend on fast food. Fortunately, Yum China recognizes this as one of their biggest weaknesses, which is why I talked about their shifting towards an affordable pricing model in Pizza Hut and KFC. Fourthly, the threat of substitutes is low. That's because in the current trend of China, we're seeing that Yum China and the broader fast food sector is becoming the substitute for these sit-down restaurants due to rapid urbanization and busier lifestyles. Finally, rivalry amongst competitors can be considered significant. We see McDonald's growing in the region. We see Starbucks and Luckin Coffee growing in the region. But Yum China is able to use their economies of scale, their brand strength, and their digital loyalty to continue outcompeting. Let's take a look at Yum China's balance sheet, which is simply pristine. Since 2022, Yum China's net income has doubled. Their earnings per share have doubled. And their revenue has grown 18%. What does that tell us? Well, it tells us that not only are they growing their top line revenue, but their bottom line profits are growing even faster, which tells us they're achieving efficiency like no other brand. So, let's get on to my discounted cash flow analysis, where I came to my 80% upside of $81 a share. Now, my key assumptions are a 6% revenue growth rate in the first 5 years, a 3% terminal growth rate, a 7% discount rate, and increasing cash flows over time. Now don't worry, I know you may be wondering, how did I come to these numbers? Well, here it is. The 6% revenue growth rate aligns with historical averages for Yum China of 6.1% since 2015. And, might I point out, is conservative because they're growing at a record rate all time, which will make them have record numbers of revenue. The 3% terminal growth rate is conservative. I looked at long-standing industry competitors and saw their terminal growth rate. That's why I came to that number. Now, the 7% discount rate reflects strong financials. They have a 0.37 debt-to-equity ratio. They are well leveraged. They have lots of cash flow on hand. They are taking and putting back into their business, or even giving to investors in the form of dividends. And finally, I predicted increasing cash flow over time, because what Yum China is doing is taking all their cash flow and putting it back into the business. But as these restaurants begin to mature, we're going to see a lot more cash on hand. Now, I wanted to make a slide solely for dividends because it is remarkable, Yum China's dividends. Dividend payout has increased 125% since 2018. Just soak that number in a little bit. And in the past year, it has increased 50%. Now, I included a graph on the screen, Yum China compared to McDonald's. They're absolutely killing them. You can see Yum China's dividend yield is growing rapidly, while McDonald's is stagnating and declining, which shows you that they're a much more profitable business. So, let's address some of the investment risks. I know some of you are worried. It's China. It could be risky. We've seen in the past that international brands have been retaliated against when they've come into the Chinese market. But there's two things that are fundamentally different about Yum China. The first is they are solely a Chinese brand. They are not an international brand, which paints them differently in the eyes of the Chinese government. But history also backs them. They've been in China for 30 years, and they've never been hindered, even though we've seen US-China trade tensions in the past. So the risk is pretty mitigated, and history proves it. Now, the tariffs is another issue where cost of supplies and anti-US sentiment could be a concern. Fortunately, Yum China sources 89% of their supplies locally, mitigating the risk of costs. And in terms of sentiment, Trump implemented the tariffs, and after that, Yum China released their first quarterly report and saw an increase in transaction growth, not a decrease, which shows that they were not affected by sentiment. And finally, Yum China is heavily digitized, so there is a risk of cyber threats, which is why they're investing in a cybersecurity infrastructure. Now, my last slide, ESG considerations. Yum China is both well accomplished and well recognized. Now, a couple actions they've taken. They've implemented the first cold chain logistics center in China, which positions them at the forefront of environmental sustainability. They've implemented environmentally friendly packaging across thousands of KFC stores, and they have a Yum China Care program to improve employee benefits and improve the workplace as a whole. Now, for that, they become #1 in the S&P 500 sustainability assessment in the restaurant industry, China's top employer for 4 years in a row, and MSCI ESG rating of AA. So if you're hungry for growth, skip the combo meal, grab a bucket of Yum China. Thank you very much.
a lot on revenues,
Yeah.
understandably. But competition in China is crazy.
Yeah.
And some of the new coffee entrants, for example, are selling coffee at 50 US cents a cup.
Yeah.
You've got margins growing, cash flow margins anyway, growing. Are you really seeing a lot of competition?
Yeah, so we've seen competition in China for a very long time. And we've seen that consistently Yum China's been able to outcompete, both in the restaurant sector and the coffee sector. Now, I did mention, specifically you talked about coffee, right? We have Luckin Coffee, Starbucks, just entering into the market and posing a risk. But Yum China has been able to grow as well. And I think one of the main reasons they've been able to do that is targeting lower tier cities. That was a strategy that I mentioned on one of my slides. And lower tier cities don't have as much competition as these big cities do. So they're putting their K-Coffee in lower tier cities. They're putting their Lavazza in lower tier cities. And there's a lot of growth there, so there's a lot of demand, but less competition. And it's a strategy that Yum China's been able to see, not a lot of other companies have been able to see, and that's why they've been able to grow their margins, as you said.
I just wanted to dig into the discount rate, the 7%. I mean, I understand that they have a clean balance sheet, but it seems like it's potentially a little low when you think about the cost of their equity.
Yeah.
I wonder if you could double click.
Yeah, so I thought it was pretty low too. So that's why I went to third-party analysts like Morningstar, TradingView, AlphaSpread. They've all done their own separate analysis, and they've all come to the range of 7% as well. So I talked about, the debt to equity ratio is really good, the clean balance sheet. But it's not just me who's saying that, it's the professionals as well, the people who have done the analysis just like me in Morningstar, and they also came to the rate of 7%, yeah.
Thank you, Elijah.